Welcome to Hustle Estate from good old New Jersey and Detroit, Michigan. I'm one of your hosts, Isaac Gilman.
And I'm your other host, Ed Hendrickson.
So week 4,
Week 4, dude.
dude, we're going into a month. It's insane.
I know. The end of
On
what's it?
or just about. It'll be next week that it'll be like I'll be a month work from home.
Damn.
So wait, you were just saying that there is a lender or lenders that are still doing hard money loans?
So the deal is the answer to that question is some lenders are still lending. Now it's kind of so when basically what happened in this market is the way hard money kind of originally came out was people were lending either their own money, family money, maybe 10 people got together, small funds, medium-sized funds, right? When I used to
Sure.
work at asset-based lending, they are actually set up as a fund. That was kind of their core strategy was we're a fund, we're going to hang on to these things. If the market ever tanks, we're still going to be here. And they at the time were talking like, if an 08, 09 ever happens again, we'll be here. We're not dictated off of any secondary market.
Oh, so
So
you're saying these funds are post 08, 09. So they're not like, this is not like the original hard money. This is like what came out of the housing crisis is hard money. These players decided they were going to play the game in a
well, the
way
game
they
changed
thought was
like kind
safe.
of like there was a game prior, which was just
Sure.
again probably more. Well, I mean, I wasn't involved. We were in college at that point,
Right. Right.
but
Right.
those were probably more traditional, more of what hard money lenders we're seeing now. Again, back to this like I have a wealthy friend or like,
Yeah. Yeah.
10 guys pool their money or whatever the case, like that's what hard money used to be. And after 08, 09 happened, ABL kind of set their shop up and those guys decided that they would scale larger than that competition space, create a big fund, 50, 80, $100 million fund, and go out to the market and lend. So it's kind of what they were doing for a while. And sorry for ABL if I'm, pitching this or portraying it wrong, but in essence, the point is they became a fund.
Right.
Most other lenders out there prior to this pullback due to Corona here and maybe some sort of normalization due to Corona is what happened is secondary market insurance companies, large hedge funds wanted a piece of this action.
Yep.
So what happened was guys like myself, and even I mean I would dare, so larger than me, were able to close down on one or two loans maybe with their own capital, and then they were selling them into the secondary market. And it even got to a point where there was intermediaries to that. So what would happen is I might close on two loans with my own capital. I would sell it to a company that was buying 100 of these. They would pool those 100 together and flip it into the massive secondary market. I'm talking like the large names that we can like PIMCO, for example, a bond company, like they
Sure.
would be buying something like this. So what happened when this market changed currently is companies like PIMCO started saying, I don't want any of this stuff on my books right now. We don't
Sure.
want any more of it.
Right.
That immediately took that 100 fund lender out of the play because they weren't really at capitals. They had enough money to pull in these deals and sell them immediately. They weren't really they were well funded for that, but not well funded for long-term holding. And then again, that put out people say like me in this scenario, which isn't me. I wasn't ever this person, but the guy who did the ones and twosies here didn't want to do it anymore because now if I do one or two, I'm stuck in the two deals for the duration of the period at this point. So to kind of explain all that, there are some guys out there still that have like ABL is still around. The one of these companies that I can speak to um, that I know in the market, and again, I'm not going to name any other names here. It's just they had less capital but sold a lot of stuff. So what they're doing now is just using that less capital, maybe it's 5 or 10 million, and choosing what deals they want, prepared to hold them now at this point. So they're cherry picking the deals. There's a couple people out there still doing that. So anybody who's doing a loan right now, in essence, is understanding I have to hold on to this for 12 months.
Yeah.
Now the risk changes. They want higher interest. Just forget the um, general corona risk. It's like if I have to hold on to this, I want more money. I want more interest reserves. Because it usually just be like, who cares? You take it and sell it in and out, and just turn it over as many times as you don't even care about the risk at some point because you're just dumping it back onto the secondary market. So since there's no liquidity in the secondary market, now we're back to the original guy who's got 5, 10, $20 million person or 5 pool of people doing that. So terms have changed. So that's coming back, but all that kind of went on pause too for the first like 2 weeks. It was just like people were like, we're not lending. We have no idea what's going on. We're not lending. So, and again, don't get me wrong, some people still lent through that, but most people said, hold on, let's just see what happens with this market. So one of my lenders that I've worked with for a while, they were both. They had a pool of money, $2, $5 million, whatever it is, that they did deals with. And then they had this other side, which was that model I just told you. They did a loan or two, sold it into the market, and kind of moved on. So they always looked at deals and said, do I want to hold this or do I want to sell this? So they did deals and just made a decision when it was time to close. Like, is it going to be our money for the whole time, or is it going to be money that's going to get sold into the secondary market? So now they don't have the secondary market. So they're just conservative anyway. They've always been more conservative with their money. And now add in this. So we're learning here.
Right, so they're only doing deals that make sense, like that really are kind of slam dunks.
Correct.
Right, because you're basically saying that some companies, right, yeah. I mean, this is how a lot of the non-banks became lenders. Right? Like Quicken Loans, they basically, they're not a bank, but yet they are a huge lender. And I mean, they're much more mature as a company than they were, 5, 10, 15, 20 years ago. But it's not like they have some federal, like they don't have some regulation where they have to have money to fall back on if, there was a run on the banks, for instance. Right. That's because they're not a bank. And all the whole housing crisis stuff, like a lot of the regulations that banks had to fulfill, they don't. They have other regulations they need to fulfill because they're still a broker or an originator and whatnot. But and to be fair, Quicken is like in a very good position at this moment. But I think what you're talking about is what other maybe smaller shops or shops that were very like quick to turn over because they may not have a lot of liquidity or they might not be well capitalized to hold on, whether it's servicing the loans or at least figuring out, okay, now I have to wait for payment to potentially like pay off a credit line or however they're borrowing the money in the short term.
Correct.
To solve those problems.
Yeah, I mean, it's kind of like hot potato. It's just like, that's why everything stopped because nobody wanted to take anything more on because they didn't want to get stuck holding the bag. Now, Quicken, I guess, I mean, obviously way more, but the Quicken is a very large broker, so they're selling too, but they're not selling from even, if you were to name any other broker in your local area, like, they're like people that our parents would use in this local area or we would use in this local area. I don't really want to name people or say anything, but those guys are nowhere near the size even of a Quicken, right? Even at a level of their, the largest one in northern New Jersey, but like Quicken's doing this across country. I would imagine Quicken is probably one of the largest brokers, like right behind a retail bank being Bank of America, JP Morgan, right? Like JP Morgan, Bank of America are holding this stuff.
Well, Quicken's the largest retail lender in the country.
Right, there you go.
And they have been they basically, Wells Fargo was, and then Wells Fargo had all their scandals. And they've been the largest since Wells Fargo fell off.
So who buys Quicken's paper when they sell it? Or do they hold on? Because they have to be selling it, I imagine. So where are they getting their money from?
Yeah, so I mean, they
don't have deposits the way a bank does, in essence.
Right, but a lot of these non-brokers, my understanding of how it kind of works at a very high level is they sell their loans to Fannie, Freddie, Ginnie.
Exactly. Yep.
But they get the money. They originate the money through
warehouse lines.
Warehouse lines of credit.
And very similar to hard money.
Right, but I think that's how all mortgage basically business works. We borrow at a very low interest rate because you're borrowing a ton of money from, I don't know, probably a very large bank. I don't know if it's an American bank, but and their interest rate, let's say maybe it's like 1.5%. I mean, maybe it's nothing now, but it's still, I mean, if you borrow $1 billion,
JP Morgan, who's borrowing it directly from the Fed, at 0%, and then
Right. I mean, yeah, if you have a credit line of $1 billion and you pay a percent on that billion, you owe quite a bit of money in a very short period of time. You know what I mean? Like you run through that fast or quickly. But yeah, so they ultimately sell back a lot of their stuff is sold back to, you know, to the big names. I'm sure they sell it directly to private. I mean, they have a whole capital markets arm that does stuff that I have no idea about.
Yeah. Well, you're doing conventional and all that stuff. You are FHA, Fannie. But the good thing about you guys is you have Fannie backing you. There's always they're always going to buy, basically, right?
And actually, what you say something interesting. So when I was looking to buy my condo, and I learned about this, I didn't know about this when I was looking for condos, but when I went to go buy my condo, I was working with a loan officer, and as a Quicken employee, or as a family of company employee, they give their team members a very, very good, not just interest rate deal, but they give them like very good access to loan officers, basically. So like my loan officer, I could literally call, it's an extension away. I don't have to like go through the normal public lines to go talk to my loan officer.
Mm-hmm.
And so like we had a lot of discussions, and ultimately what he told me was, he said, you might not be able to get a conforming loan because your condo doesn't meet certain basically requirements. Basically, my understanding of it was
or non-warrantable condo.
Yes. So like basically the difference is do you have enough homeowners living in the unit, or is it mostly a rental property? Because if it's non-warrantable, they look at it as an investment, basically.
Yep.
That's my understanding. And so there is some downside to that, which is there's no reason they should give me the benefit of a traditional 30-year mortgage interest rate on an investment property. I mean, that's basically cheating.
Yep.
So they weren't willing to do that if the property was deemed non-warrantable. They eventually were able to deem it warrantable, but they basically said, we might give you this option, because as a team member, they're willing to go a little bit extra to say, traditionally, we wouldn't give this option to a normal person, but we would be willing to give you a loan and hold it on our books if you're able to put this extra money down, but your interest rate will also go up by a point. So,
right.
I think it was close to 5% at the time. I wouldn't have been able to pay extra to lower my points either. I would have had to pay some more closing costs, but they were willing to put it on their books. They called it a portfolio loan. I don't know.
Exactly. That's what they portfolio it. Mm-hmm.
And, I mean, at the time I didn't really think about it, and ultimately I didn't have to do that. I have a traditional 30-year mortgage that was probably sold to Fannie. But it was an interesting process nonetheless. And I assume, I doubt Quicken has a ton of loans on their books. They just probably don't.
Yeah, it's not their model.
Right. Whereas you're saying that this lender has a model that likes to hold these, exactly. To hold these and to sell some, but to also hold.
Yeah. So a lot of people have gone away overnight, in essence, or at least are on hold. Even some major players in the industry, because there are some major players that was their model. They originated the loan and sold it immediately on the basis of, they were doing, 100 originations a month on this, but sold the whole entire thing off to Wall Street. So yeah, lots of changes, but I mean, the thing is, it's interesting, there's some sort of, people are figuring out what they want to do. Obviously every deal is going to be case by case here, but I still think that the larger thing is that's going to just delay everything is, where's this market going and what's this market going to look like? So it's not so much now a matter of like, I think these lenders are kind of coming back with their new terms, and there's an interest reserve is a big thing that's going to be in our industry now. So basically, for those who don't know, they're going to want you to prepay, say, 6 months or a year's worth of interest, which is pretty crazy considering these loans are already only 12-month loans.
But I was going to say, that's basically paying all of your interest up front.
Yeah, exactly. So, you get it back, right? But it's still a lot. But look, if you have good deals and you want to do them, but now we're talking, do you have good deals? We don't know whether we have good deals or not, because based off the after repair value, and an after repair value is what is the property going to sell for when it's done? But that done price is based on today's prices. So if we're doing an after repair formula, we're saying this is what it would sell today. However, we need to now take into calculation, is the market going to go down over the next 6 months? Then they want to haircut this after repair value. So again, it's not necessarily, I wouldn't call it back. They're a lot closer to figuring it out. And some lenders have just like, it's interesting. They've been like, you know what, we're going to lend and we'll see what happens. I mean, that might be a good call and it might be a bad call. So we might find out even in 6 months that those lenders don't exist because the deals didn't work out. And, again, are people going to afford to be able to pay is kind of a question, right?
Yeah, I guess I mean, we can kind of end on this, but like, I wonder what is a leading indicator of a failing housing market? Because, I don't know. Obviously, you can talk about default rates and like, are the default rates going up? But by the time somebody's defaulting, there's already a problem. And obviously, job loss could be a leading indicator, I guess. But I don't remember if like unemployment, even though I don't think that's a great metric, but I don't know if unemployment was ticking up at the housing crisis issue. Like
it was partially supply, I believe, that helped. There was an overload of supply, which depreciated the prices. And then that's when things really started to change because up to '08, prices were just going up. So it was kind of I don't want to beat a dead horse here if you know this, or we have another episode on this or not, but basically housing prices were just on the rise and nothing was stopping them from going up because everybody was buying because it was kind of the system was broken to enable people to get loans through mostly some of the pain was through an ARM, so adjustable rate mortgage. So they had these rates that they let you in. And then when that rate spiked up after the lock period, it was like, oh my God, I have to pay $4,000 a month for this house. I can't afford that. And then everybody went to go sell and values came down. Now nobody could sell their house for what it was actually worth, where the loan was. Hence the market overall, very general. Hence the market then went down. And it was just like, do you catch a falling knife at some point?
Because the thing is if you have, let's say, I mean, right now there's 10 million unemployed people, theoretically. It's probably more than that, but that's at least what's been captured in the unemployment statistics. Are those 10 million people going to be employed in 3 months from now? Because if not, and let's just say half, or let's say even a quarter, own a home, and they're not going to be able to pay their mortgage, right? That's going to cause a housing issue.
Yep. Well, that's what this is. I mean, this is a health issue that's now which has caused an economic issue, not the other. Like the last one was a housing crisis causing an economic crisis in essence.
Right. I guess my question though is like, what are these indicators that would say, to your point, like if after repair value is, let's say, 150,000, is 6 months from now that really going to be 100,000? Because
that's
the market,
scary.
And I don't know. Well, whatever it is, 125 or even 130. I guess.
I'm hearing 10 to 20% the lenders are haircutting. That doesn't necessarily mean prices will drop that much, but that's where they want their risk to be.
To be safer, yeah.
Yeah, but I'm hearing more. It could be 5% drop in housing prices, which is pretty substantial. Yeah, that's substantial. It's a lot. Think about it. I mean, crunch the numbers. How much did you buy your house for? What's it worth? And then you even just yourself, how many years ago you bought it? 5 years ago, you might just have lost any of that sort of appreciation that you got.
Yeah.
So, and obviously different areas of the country are going to hit worse than others, but so awesome.
You want to wrap it up?
Sure. Well, thank you everybody for listening here today. We really appreciate it. As you know, you can check us out on Spotify, Google Podcasts, and iTunes. If you want to email us at hustleestate1@gmail.com. And on our social media platforms, we're on Twitter and Instagram @hustleestate. Thanks for listening, everybody.
Thanks, everybody.